how is Business Cycle Fund different from any other, say, a Flexi Cap fund? Let's begin there and understand more about the fund.
I think the most important part is how do you rotate those sectors. When you look at the historical data, you will see that diversion where for 2 years one particular sector does well and then it goes down and new sectors come
I
up.
would like to understand about the markets because there's a lot of us going on, so markets are going down. So what's your current view on the market?
I've been telling the investors that the biggest risk for the market is earnings growth. The longer you are in the market, the better your higher probability of making good returns.
How is DSP as a firm, as a fund house different from other funds? What's your philosophy when it comes to picking out stocks?
Friend, that manufacturing as a sector has got a very good runway in the Indian market for the next 5 to 8 years. Electronics is a very big theme which is picking up in India, and that could become a very large manufacturing industry.
So Mr. Charanjit Singh is a seasoned portfolio manager at DSP Mutual Fund, currently managing the DSP Tiger Fund, with focus on India's infrastructure growth and economic resilience. With over 2 decades of experience in equity markets, Mr. Charanjit has built a reputation for identifying high-impact investment opportunities in critical sectors. Known for his deep sector insights and strategic approach, he has a proven track record from senior roles at renowned firms like Batliwala and Karni, Axis Capital, and BNP Paribas. His experience spans both Indian and global markets, making him a trusted voice in complex sectors vital to economic growth. So thank you for joining us today. So like I begin with all the fund managers, I would like to understand how did you end up in the fund managing space, or how do you know that this is what I want to do for the rest of my life?
Yeah.
Basically manage funds.
Okay. So if you see, my journey with DSP started in 2018. Prior to that, I was a sell-side analyst, and I used to cover most of these stocks in the various brokerage house firms, like you mentioned, B&K Securities, Axis Capital, BNP Paribas. And after covering a lot of these sectors and stocks for a long time, and recommending these stocks to the fund managers in India and globally, then I thought this was a good time to make a switch to the investment management profession, or which is called the buy side. And in 2018 joined the DSP investment management team. Because I had expertise in the capital goods, infrastructure, power utilities, these sectors, so I was given the responsibility to manage the DSP India Tiger Fund, which has been the flagship fund for DSP India. And we were also starting on a great journey where manufacturing sector was picking up, and my expertise and the fund helped, and we had a good runway from there on. So it was a best way to utilize my skills, what I had learned in the sell side days.
So you've been in the industry for more than 2 decades currently. So how is DSP as a firm, as a fund house different from other fund houses?
Yeah. So when I look at fund management, I think the most important part is you have to always look at longevity in this profession, because the longer you are in the market, the better your higher probability of making good returns. DSP is a firm which has been there in the market for more than 100 years. If I look at from the management perspective, from the team perspective, I think there is a very strong focus on companies which have good track record, corporate governance standards, and great ethics. I think that is one thing which always differentiated DSP, and we have always kept our ethics and corporate governance standards at the highest level.
Got it. So I would like to understand about the markets because there's a lot of us going on, so markets are going down. So what's your current view on the markets, and what do you think is going to happen? Is it going to be a sideways rally? Is it going to be upwards bounce back because it hit a support level? Is it going to go down? What is your view on the current markets?
So when I had been meeting investors, so 6 months back also they had a concern. What is the biggest risk for the market? I've been telling the investors that the biggest risk for the market is earnings growth. If the earnings growth doesn't come in, you will definitely see correction in the market. So you have seen in Q1 earnings disappointed. In Q2 again earnings disappointed, and earnings cuts have started coming in. We are seeing that a lot of companies which were earlier forecasting very high growth numbers, they are not able to deliver. Maybe this could be momentary, because if you look at the central government spending has not picked up in the first half, it has disappointed. If you look at consumption, Urban consumption specifically continues to remain weak. We can see that in the four-wheeler numbers. Export markets are also going through a tough phase because larger markets like US were going through the election phase.
Yeah.
And plus, we are also seeing the Red Sea issue, which has impacted the freight, and exports again got impacted. So I think multiple factors, and along with that, the run-up which we had seen in the market, all culminated together, and that led to the correction in the market. Additionally, we have also seen FI selling as US markets become stronger with the Trump government coming in. There is a scenario that there will be strengthening of the dollar. The US markets will become stronger. That is why the FI flow is moving out from India to US.
Correct.
It is not moving to China. That was a common perception. So it's moving to a much more stronger market, and I think this outflow could continue for another month or so till the Trump administration comes in and takes over by Jan 20th. Post that, I think the things could stabilize. So from Indian market perspective, I think that the premium which Indian market is getting on the multiple side, that would sustain, because as a market, our macro continues to remain very strong versus a lot of other emerging markets. Also, I think that Chinese market may see much more challenges going forward as US Trump administration goes ahead and imposes very heavy tariffs on China.
Yeah.
And China, being an export economy, will continue to face much more bigger challenges going forward. So what it means is for the Indian market, as earnings cut cycle reduces by Q3, in the fourth quarter, central government spending picks up, US government takes over, and stabilization in terms of the flows start happening. From there on, I think our growth trajectory on the earnings will start picking up. FY26 will see better earnings growth, and that is where the re-rating in the market will start. But I think investors have to now tone down their return expectations. What we have seen in the past is a raging bull run where the returns have been phenomenal. So what will happen is, while our PE multiples remain elevated, but the market movement will be driven mainly by the earnings growth. So what it means is that as an investor, you should have a realistic return expectation of maybe 12 to 15%. And as the earnings growth picks up, that's how the market momentum will pick up. We have a very strong macro, and a lot of volatility will reduce as we go forward in Q4 and FY26.
So you mentioned about the Trump administration. So how do you think this election results are going to impact India in the next 5 to 10 years, or is it going to impact in a bigger picture?
Yeah. So when you look at the way Trump administration has been thinking about, their entire thought process is that one, they want to impose heavy tariffs on China because their reliance on China from manufacturing perspective had increased significantly. If you look at a lot of components or a lot of products, 50 to 90% of their manufacturing is happening in China. So during COVID, this kind of over-reliance on China became a big risk for the global supply chains. As the economic shift is happening, as the world order is changing, like Ray Dalio, who is of Bridgewater Associates, talks about that. There's an increasing push that there has to be a China plus one strategy. That is where they are imposing tariffs on China, and these tariffs could be to the extent of 60%, which will actually bring down their exports. On the other hand, India is going to benefit, as in a lot of segments, India will become an important partner for US. So that is where China plus one strategy is positive for India, for the manufacturing sector. We have seen government also taking important initiatives of performance-linked incentive schemes, where they are trying to scale up the manufacturing capacities. India is being looked as a very trusted partner by most of these developed countries, with a skilled manpower and with ability to scale up in a lot of these manufacturing segments. And I think as that happens, we are very confident that manufacturing as a sector has got a very good runway in the Indian market. for the next 5 to 8 years, like you rightly asked. And it will be multiple sectors, be it the core industrial manufacturing, be it pharma, chemicals, battery, automobiles. A lot of these ecosystems will get developed, and as we get our economies of scale, India will be in a position to start exporting and become meaningful partner to a lot of these developed countries.
Let me get on to the business cycle fund.
Yeah.
So first of all, I would like to understand how is business cycle fund different from any other, say, a flexi cap fund.
Yeah.
Let's begin there and understand more about the fund.
Got it. So when you look at the funds in the mutual fund space, there are different categories. So what is the spectrum you have available? One is a sectoral fund, which is only focusing on one particular sector. So what it means is that there are a limited number of stocks and very high risk. Then there are thematic funds, which have exposure to multiple sectors, but still they exclude certain sectors because they are focusing on certain theme. Then you have the business cycle fund, which has the entire market open to them, all the sectors. And then you have the flexi cap funds. What I call the business cycle fund is the flexi cap of thematics. Yeah? It is lower risk, but it can be tuned to generate better returns than the flexi cap. And that is where we can take a little higher risk by allocating the money which the investors are giving to certain sectors where we have very high conviction. And also focusing on the sector rotations, which are the critical part when you are looking at investment frameworks. So I think from an investor perspective, the risk is less, the diversification is more, flexibility is high in the business cycle funds, and if rightly managed the way we have built our framework, then it can give a possibly higher return than the flexi cap funds. So even if you look at the mutual fund industry, pre-COVID, 2.5% of the AUM was in the sectoral and thematic funds. Post-COVID, this has got accelerated, where 15-16% is now in the sectoral thematic funds. So investors are definitely becoming very smart. If they understand, if they want to increase their overall return profile, they need to have satellite portfolios where you need to allocate to the thematic funds. But I think if you have made good amount of money in the sectoral funds, where we think the risk could be high, you can switch out of them and look at the business cycle fund, which is a more diversified, like I said, flexi cap of thematic, better opportunity right now also in the market with the way market has corrected. So all those things make this product a very good product if we are managing the way we are planning to do.
Correct. So when it comes to DSP Business Cycle Fund, because of the current market volatility, is it a pro or con when it comes to fund deployment? Because by SEBI, you must have a limit, you'll have to enter the funds within 1 month, if I'm not wrong.
1 month, yeah.
So if that's the case, is it a pro or a con?
So see, when you look at the broader market, there has already been 10% kind of a correction,
Yes,
right?
correct.
So it means that the fund is not coming at the peak of the market. As we are seeing Q3 numbers coming through, there could be some more correction which could be there in the market. It means that by the time the money comes in, we'll get good entry points in a lot of stocks. Even the market would have seen correction. So that gives, from a fund perspective, a good entry point. And I think as we get into Jan, so from January month, a lot of these volatile phases will get over. We have seen very high level of volatility in the past, 2 quarters. There was general election in India, then the budget, then Haryana election, then Maharashtra election, now US election. So a lot of these events had created a lot of volatility. I think as we go forward into Jan, Feb, March, and when our time of deployment comes in, we'll get market at a lower level. We'll also get lesser number of large events which could have an impact on the overall, fund and the stocks. So I think that creates a good runway to start deploying the money. So I think from timing perspective, I think our timing from business cycle fund perspective is good because we'll get a good entry point as we start deploying the money.
So if you could tell me more about business cycle funds philosophy, what's your philosophy when it comes to uh, picking out stocks? Yeah, if you could give me a bit more on that.
So first, I would like to tell all the investors that what is a business cycle fund, and how is DSP differentiating a business cycle fund versus maybe a lot of other funds on the street. See, business cycle funds, if you look at globally, they follow the macroeconomic cycles, right? And as you would have seen in the literature, there are 4 cycles which you try to identify and then deploy the money according to that. But our research, based on whatever has been done in the global market, has shown that it is very tough to predict economic cycles. Now, if you take the context of the Indian market itself, the GDP data comes with a 45 days lag. So, what it means is that you need to focus on market cycles over economic cycles. Market cycles are ahead of economic cycles. So, that is the biggest differentiating part of the DSP Business Cycle Fund, where we are focusing on the market cycles, not the economic cycles. Right? Second part, which differentiates us, we have built a methodology or a framework to do sector rotations. Because when you talk about market cycles, the most important aspect of that is sector rotations. How do you rotate from one sector to another? And when you look at the historical data, you will see that diversion where for 2 years one particular sector does well and then it goes down and new sectors come up the curve. But I think the most important part is how do you rotate those sectors? How do you move your money from one sector to another? That is what the framework and process we have devised, and we will utilize that to rotate the stocks across sectors. And that is where, when investors are giving me 100 rupees to invest, we can have a very well focused portfolio where we can actually say that we don't want to invest in this particular sector, and while allocate that same 100 rupees to the sectors where our outcome could be much better. So I think that is what is differentiating the DSP Business Cycle Fund. So our focus on the market cycle, our focus on the sector rotation framework. Thirdly, our focus on the business cycles of individual stocks. Because when you look at the market, each individual stock may have its own cycle in terms of how it is growing, how is the margin profile versus also peers in the same sector. So we need to be aware about that and then build our positions accordingly, whether they are in the right kind of a cycle or they are already in the late cycle. So the probability of making money goes down. So that is how our stock selection will happen. And then we'll take a call that if there are certain sectors which are looking expensive, which are having growth which is lower than the Nifty growth in terms of earnings, which have already delivered excessive returns, if we want to allocate zero weight to those sectors, we'll do that. I think that is what will differentiate the DSP Business Cycle Fund from the other business cycle funds in terms of one sector rotation, in terms of allocating more money to the sectors where you have high conviction, and in terms of also looking at the markets when you need to raise excess amount of cash. Because if you would have looked at like 2 months back, we would have been much higher in terms of the cash. As market is now correcting, our ability to deploy that money will start going up.
Okay.
So I think all these factors then give you a very good product which can have a better outcome than a normal flexi cap fund.
Okay. So you mentioned about stock selection in a business cycle, in DSP Business Cycle Fund. So how often do you rebalance the portfolio? When it comes to sector rotation, how do you decide I want to move from one sector to another or exit from particular stocks?
Yeah. So I think this is again a factor of how the returns have been for that particular sector. See, market right now has also become very fast and efficient. Sometimes when we are seeing some of the themes, maybe the next 3 years returns are coming in 1 year itself. So that is why I'm saying that you have to be always aware about the returns, what these sectors have done versus the index. Have they delivered much higher than those returns than they have even delivered in the past? Plus, have the valuations gone up to an extreme level, and earnings are not being delivered. If these three factors are there, then we'll take a call in terms of starting to trim our position, book profit in those sectors, or exit those sectors. And when we find these factors favorable in terms of maybe the stocks or the sector has not delivered the return, valuations are favorable, then we start building our position. So I think this is a very clear way and a very sensible way of adding sectors or reducing sectoral weights.
So is there a specific limit by SEBI when it comes to a business cycle fund, like multi-cap has fixed percentage? Is there any limit?
So I think the beauty of business cycle funds is the entire flexibility.
Great.
There is no limitation by SEBI in terms of the market caps which we want to add.
Okay.
We can add small cap, mid cap, large cap. There's no limitation on the percentage what we want to add. There's no limitation on the sectors. So that is what it creates. It is a very good product where you have the entire flexibility in terms of choosing the market caps, in terms of choosing the stocks and sectors.
Do you have the liberty to enter international equity?
Yeah, so international stocks is enabled. Yeah. The only thing which stops us the RBI limits.
Yes.
Yeah, which have already been hit for the mutual fund industry. Correct. But if given a chance, we have the enablement. But apart from that, I think when you look at the different cycles of the market, you need to also have other products, be it the infrastructure investment trust, be or it even adding debt into the portfolio when the market is in a position where the returns are not coming through. So I think that is what will make the product, the longevity of the fund through cycle returns, if we are able to utilize all these asset classes to generate a better outcome.
So if DSP Business Cycle Fund is able to take advantage of whatever sector that comes in that particular time period, should we go for another sector fund just in case, or should I just stick to one fund because I know this fund is going to take care of it?
Correct. So I think that's where I started off with when we said the spectrum of the funds. So what sectoral funds do is they are limited to only one particular sector. It means that the number of stocks which they can invest in, they are always limited. So when that sector goes through upcycle and starts into a down cycle, that is where the risk starts increasing for the investors. So I think that is what an individual investor cannot do in terms of rotating sectors. So in your portfolio, if you need to reduce the risk, then it's a good way to have a business cycle fund where we, like you rightly said, are rotating the sectors, are taking heavier weights in the sectors where we think that there's a much better outcome, rather than an investor who may not be able to time those sectoral calls. And the risk can be pretty high in terms of the capital which you have deployed. Apart from that, I think the other aspect to the market right now is, as you would have seen in the previous bull runs, there is always a new leader of the bull run. If you look at the last 3 to 4 years, we have seen a lot of new sectors rising up, like defense, like railways. Now, electronics is a very big theme which is picking up in India, and that could become a very large manufacturing industry. So, in the business cycle fund, we also have certain weight which will be allocated to these new sectors, which are very high growth rate, and the total available market, which is TAM, is expanding rapidly. But you don't have any major history because these are new age sectors, be it like electronics, hydrogen, battery storage, energy transition. So all these are new sectors. So you need to also have exposure which business cycle fund will be able to target and have certain weights in these new sectors so that the investors are able to even benefit from these sectors and not take the risk on their own.
So when compared to a regular sector fund, a business cycle fund has the capacity for sector rotation basically.
Correct.
So on top of that, do you have any other risk mitigation measures or hedging mechanisms inside inbuilt?
Correct. So when you look at the market, like I said, in the last 2 quarters, market has been extremely volatile. Even if you look at the Tiger Fund, most of the risk mitigation factors which we are going to talk, we have also done that in the Tiger Fund. So I think first is definitely, like you rightly said, hedging. So we use the put options when we see that the market is at a very volatile phase and there are events which could bring the market to correction. Secondly, we are also aggressively raising cash when we see that the market's at peak and there could be much higher risk to the overall market. So that's another risk mitigation or arbitrage position. And third, lastly, the infrastructure investment trusts, because these could be the products which could give you good yield in this kind of a tough environment. So if you have all these risk mitigation factors, it could have a very positive impact on the portfolio in the volatile markets. So we will implement all these things in the DSP Business Cycle Fund so that we are able to ride through the volatile times in a much better way.
Got it. So you have clearly told me how the fund is going to take advantage of the market cycle that is coming down the line. So I have pretty much covered up all my questions. So I'm coming down to the last question that I asked to all fund managers. So how does your personal portfolio look like? If you could give me a allocation of the different asset classes that you have, that'd be great.
So for us at DSP, it is always that you need to have skin in the game.
Yes.
And I think that's a very positive thing, because if I'm recommending it to my investors, I should be also invested in that. So right now I was managing the DSP Tiger Fund. So most of my investments were going into the DSP Tiger Fund. Now, as DSP Business Cycle gets fund launched, so the split in terms of my investment will be between DSP Tiger and the DSP Business Cycle Fund. So I think that is what we want to do, because we are managing people's money. It's our fiduciary duty, and we have to also invest with them. So that's where we invest with them, and we invest as a together with the investors, and I think that's where the outcome has to be best for everybody. And apart from that, we have the other option to invest in our own funds, and as and when we get the option, we will definitely exercise that and invest in the other DSP funds.
Yeah. So apart from mutual funds, are there any asset classes? And if you could give me the percentage wise of the overall portfolio.
So no other asset classes, apart from the mutual fund,
Full
because
equity.
we don't do direct equity.
Okay.
We only invest in the mutual fund, and that too in our own funds.
Got it.
Yeah.
Okay, thank you so much for your time. This
Thanks
has
for your
been a
time.
very
Thanks for the
insightful
opportunity.
conversation.
Yeah. It was great. Thank you.
Yeah.